Welcome back. You're watching Buy Now, Sell Now on ET Now, and we have the management of Embassy REIT. We are joined by Mr. Vikaash. Good morning, Mr. Vikaash. Thank you for joining us on ET Now. Let's talk about the quarter gone by. How did the company fare in the quarter gone by? What was the impact of client renegotiations? Also, have any clients actually dropped or renegotiated the rental rates?
FY21 was a resilient year for us. Despite the pandemic impact, we distributed over 1,800 crores to our investors. Our NOI grew by 12%, and we in fact collected over 99% of our rents. We have not seen any client renegotiation, simply given the quality of the occupiers that we have in our portfolio. In fact, we have leased 12 lakh square feet of new leases in this pandemic year across 43 new deals during the course, as well as collected rental escalations of about 13% on 84 lakh square feet of existing leases. So our portfolio remains resilient.
Talk about the collection efficiency of rents in the quarter gone by. How was it like? And also going into Q1 FY22, how have the client renegotiations actually panned out, considering that we are seeing the second wave of COVID-19? What percentage of your clients have actually asked for reduced or change rental terms?
Yeah, so our rental collections remain at over 99%. We've seen similar trends continue in Q4 into Q1 as well of this financial year. We have not seen any client renegotiations because these are high quality occupiers, global occupiers we're talking about, and the lease contracts are long-term in nature, and the existing in-place rents are far below the market rents for the occupiers. So I think we have not seen any of that impact. Just to take a step back and put it in perspective, we see the long-term fundamentals for the office market in India to be really strong, and there is a huge pent-up demand. So what the second wave has done is it has deferred the timing of the demand bounce back. But what we see on the ground is that, one, our occupiers continue to grow. We have heard news of record deal wins and record hiring plans, simply because there's huge effort globally to make more spending, increase spending on digital transformation. That means more businesses for our occupiers, and they are growing. Two, our occupiers continue to look for talent in India. That's the key advantage we have in India, and that means there's an estimate of about 3.5 lakhs employees being hired just in FY22 alone by a recent NASSCOM and Kotak report. That's a record number, and highest in over the last 15 years. So what we're seeing is that both the impact of the growing businesses of our customers and the record hiring plans will result into more demand for safe, secure, and wellness-oriented properties, the kind of properties that we at Embassy REIT cater to. And I think that will help us benefit as demand picks up in 2 quarters from today. That will really mean a great amount of new demand for our properties to the benefit of our portfolio.
Mr. Vikaash, could you take us through what the dividend distribution policy is going to be going forward, and also what were the occupancy ratios of the properties that you currently manage?
So our dividend distribution was a healthy 100% payout ratio in FY21. We distributed over 1,800 crores. It was our 8th successive quarter of distributions, and going forward, our policy remains unchanged. Simply because our rental collection figures remain robust at over 99%. Our occupancy remains healthy and at 89% as of the end of March, and reflects the healthy and the best-in-class quality portfolio that we have with us.
All right, now there's a 2-tier holding structure of Manyata, and that has been collapsed. Will this now result in a more tax-efficient distribution payout?
Yes, that's correct. So in the last quarter, we simplified the holding structure of Embassy Manyata, one of our largest assets. And what it means is that the dividend component in the distribution increases substantially, And just in Q4 itself, the tax-free component of our distributions was over 75%. So that's a significant enhancement in the tax-free component, which is beneficial to our unit holders.
Mr. Vikaash, can you talk to us about the expansion plans for the assets under the REIT? What are the properties that you would consider adding? We understand that mainly commercial properties are being looked at as of now.
So, as you may recollect, we have a very strong balance sheet with a low leverage of 22%, and that supports our growth plans as we look beyond the pandemic. So, first, the 11 lakh square feet that we are currently constructing, which is the JP Morgan campus, that is on target for completion in September 21. So that will help us enhance our NOI and our DPU. Secondly, what we're also doing, we are seeing this pandemic as an opportunity, and we have commenced an additional 46 lakh square feet of construction across our existing properties. And the timing of the delivery actually ties up pretty well with the expected bounce back in demand. The supply, as per CBRE estimates, has shrunk by 25% already. So we think this will help us with our organic growth. On the inorganic growth front, given our balance sheet strength, we are continue to evaluate new acquisition opportunities, and we are looking at mainly top quality, large scale campus style office properties. If you recollect, we had completed the Embassy Tech Village acquisition in last quarter of the calendar year, and the accretion from that acquisition is already reflected in our Q4 numbers, both in our net operating income as well as in our dividends. So we will continue to pursue that and evaluate each opportunities that come our way.
All right, on that note, thank you so much for joining in, for taking the time and for taking us through the plans that you have for the company. We're slipping into a short break now, but more on the other side, so do stay tuned.